Hi, I'm Stacey and I'm back for another episode of Better Financial Health in 15 minutes or less. And today I'd like to discuss something that came up in a meeting I had with a client yesterday. And that's the concept of high yielding investments. They were looking for something that yielded in the neighborhood of 16%, which made me go, huh? Because what you have to look at on an investment is not what the yield is. Now, yield is what it's paying out. And certain funds or investments can have eye-popping payouts, but what it may be disguising is where is that payout coming from? In most cases, if something's paying out at that high of a rate, they're paying you back part of your own money over time. So it's not really all income. Part of that is you're getting your principal back. Or, quite frankly, it could be a sign of some sort of fraud or Ponzi scheme. Because what you want to look at when you're evaluating any type of investment is, what is my total return? And what do we mean by that? That's a term that's used a lot, but I think maybe a lot of people are afraid to really ask what it is. That's when you take the dividends and interest from an investment plus the change in the value of the investment, also called net asset value or NAV. So when you factor all of those in together, that's how you calculate your total return. And then you also have to take into account, yes, an investment may be easy to buy into, for instance, a closed-end interval fund. It's easy to give them your money, but they often have pretty restrictive ways that you get your funds back. They may limit you to requesting your money back quarterly, and that fund manager may limit that to a percentage of the funds in the account, so that you can't necessarily get your money if a lot of other people are wanting to get their money, which can be a problem, particularly if performance doesn't measure up to what it had done in the past, which is the reason everybody bought. So you definitely want to look at, how do I invest in this investment, and how do I exit if it does not work out? Those are key things to keep in mind. And sometimes people look at these sort of high yielding investments. They will be in business development companies, real estate, private credit. All of these are pretty risky investments, and they're also harder to diversify. It's pretty easy to get diversification in stocks because you can buy a fund that invests all over the country or even all over the world. But when you talk about real estate is hyper local. If you are investing in one of these high yielding real estate funds, it's likely because it's doing some sector of the real estate market. And it could be limited in geographic regions. So you really want to pay attention and make sure you've done your homework. You're not just being caught by some returns or some yield there. Also, that kind of applies to everything. High yield bonds pay more than treasuries and high grade corporate bonds because they have significantly higher risk of defaulting. What default means is a bit like bankruptcy. In some cases it is bankruptcy. It means they can't meet their obligations, and so therefore you're not getting your money back. So you just want to be aware when you're looking for investments. I really encourage you to stay away from the hot shiny thing, the things that you see on Reddit boards, because a lot of those people do not have your best interest at heart. They may have bought it and then they go on these forums and they talk it up, hoping that other people will buy it, and then they sell it. If you don't believe me, go watch The Wolf of Wall Street. That is very much what you see a lot of times in these low price penny stocks. It's called a pump and dump. They buy it, they talk it up, then they sell it, and then the people who listen to them are the ones taking the losses while they're going to the bank with their winnings. So slow and steady really does win the race, investing consistently over time, staying invested, because in the short term, we don't know what markets are going to do, but over the long term, I am extremely confident that the market is going to win out. But I mean the market, not any one particular stock. So invest, don't gamble. Thanks for tuning in. This has been another episode of Better Financial Health in 15 Minutes or Less.